In this podcast episode, Jeff Snider provides a deep and nuanced exploration of the current economic landscape, challenging common narratives about the stock market, inflation, and the labor market. He discusses the disconnect between financial markets and the real economy, the lingering depressionary conditions masked by headline economic indicators, and the structural shifts since the 1980s that influence how people save and invest today. Jeff also unpacks the supply shock origins of recent inflation, the labor market's failure to recover post-pandemic, and the pervasive demand for safety and liquidity in financial markets. The conversation then touches on systemic resets, the role of the Eurodollar system, and the prospects for a new monetary order influenced by technology and geopolitical forces like China's gold accumulation. Jeff begins by stating that the stock market is a poor indicator of the actual economy. Contrary to the common belief that a booming stock market reflects economic health, he explains that the stock market's rise primarily reflects increased participation and money flowing into equities, especially through passive investments in retirement accounts. Since the 1980s, a cultural narrative shifted people's saving habits away from traditional deposits into the stock market, inflating valuations irrespective of the real economy's conditions. Thus, despite record highs in the market, the broader economy suffers from sustained depressionary conditions, evident in stagnant incomes, limited job growth, and widening inequality. Jeff introduces the yield curve as a crucial financial indicator, describing it as the line plotting interest rates from short-term to long-term Treasury yields. A normally healthy economy features a modestly upward-sloping curve, signaling positive growth expectations. However, today's yield curve is flat and low in nominal terms, a signal that risk and fear dominate markets. Low rates during these times reflect an intense demand for safety and liquidity rather than stimulus or inflation. This pattern is reminiscent of depressionary periods like the 1930s and Japan's lost decades, where safe government debt remains in demand despite enormous government deficits and economic malaise. Contrary to popular wisdom that low interest rates cause inflation and high rates suppress it, Jeff explains the historical reality is the opposite. During deflationary and depressionary times, interest rates fall, reflecting a flight to safety and liquidity, while during inflationary periods, interest rates rise because investors flee safe assets to chase real economic opportunities. The recent inflation spike in 2021-2022 is attributed not to monetary policy, but to a classic supply shock, demand rebounding quickly post-lockdown while supply chains and labor markets remained constrained. This mismatch drove prices up rapidly before settling into a new, higher price plateau. The labor market's recovery post-pandemic has been underwhelming, with payroll growth stagnating at levels far below historical trends. Jeff highlights that official statistics show millions fewer jobs exist compared to where they should be based on demographic growth and past trends, creating a K-shaped economy with uneven recovery and growing inequality. Companies found nominal revenue rising due to higher prices, but did not rehire workers proportionately, relying on productivity gains instead. This environment impoverished many workers and suppressed broad-based income growth, perpetuating a cycle of underconsumption and economic stagnation. Jeff elucidates a significant cultural and financial transformation beginning in the early 1980s. The structural change led to a system where people shifted from saving in safe, interest-bearing deposits to speculating in equities, fueled by the rise of retirement accounts and passive investing. This change disconnected the stock market from economic fundamentals, with more money flowing into equities regardless of economic conditions. While modern bubbles like the current AI exuberance exist, these financial market movements often reflect behavior more than real economic health, contributing to disconnect and confusion among everyday people. With income stagnant and wealth increasingly concentrated at the top, many people, particularly younger generations, feel left behind. Jeff explains how this economic context makes socialism appealing as a critique of a system that seems rigged and unresponsive. Drawing parallels to Marxist theory and end-stage capitalism, he describes how capitalist economies in their mature stages exploit workers by cutting wages and jobs, making essentials unaffordable. While socialism is seen by some as a solution, Jeff asserts that historically socialism exacerbates problems rather than solving them. Still, understanding this appeal requires recognizing the genuine hardship wrought by collapsed economic mobility and opportunity. Jeff situates the current economic malaise within long-term cyclical patterns of boom and bust, citing the post-World War II recovery as a historical reset that unleashed decades of prosperity. The war's destruction reset economic imbalances, and the US dollar's role as a global reserve currency helped finance and stabilize growth. Looking forward, Jeff suggests a new reset will be required to overcome the present stagnation, but the path is less clear this time. It may involve technological innovation, new monetary frameworks, and geopolitical shifts, rather than the cataclysmic shocks of the past. One of Jeff's key insights revolves around the Eurodollar system, a largely invisible but vital corpus of offshore dollar-denominated deposits that form the foundation of global finance and trade. Unlike physical cash, this system is ledger-based, allowing money to move fluidly and rapidly worldwide. The Eurodollar system enables global commerce and credit, acting like a circulatory system that oxygenates economies. Its breakdown in 2007 triggered the financial crisis, leading to increased risk aversion and a prolonged period of economic stagnation as trust and liquidity dried up. Jeff suggests that the future of global finance may involve a transition to a new, decentralized digital monetary system that reestablishes trust among participants without reliance on traditional banks. Such a system would leverage blockchain or stablecoin technology to create provably real and transparent ledgers, which could bypass some of the legacy risks and distrust undermining the current monetary order. This new system could restore liquidity and risk-taking, animal spirits, necessary for a prosperous economic cycle, much like the breakthroughs that drove the post-war boom. Jeff addresses China's recent monetary and economic moves, particularly its accumulation of physical gold and clampdown on paper gold trading domestically. China faces a dual crisis, banking and property, that limit its options. While building gold reserves may signal an attempt to bolster financial security and reduce dollar dependence, China cannot realistically replace the US dollar as the global reserve currency. The yuan lacks the necessary global mobility, acceptance, and the legal and institutional supports that underpin reserve currencies like the US dollar. Moreover, China's political and legal environment undermines trust, which is essential for any currency aspiring to global reserve status. Given the prevailing uncertainty, Jeff underscores the importance of balancing investment strategies between risk-on assets and safe havens like US Treasuries and gold. The heightened demand for safety is a defining feature of these depressionary conditions. He argues investors should not blindly trust overly optimistic mainstream narratives about economic strength, but rather be prepared for volatility and downside risks. The market's uncertainty is unpredictable and persistent, warranting caution and hedging against potential shocks that could emerge swiftly. Jeff stresses that while a better future is theoretically possible, through innovation and monetary evolution, there is no guarantee and time is limited. The existing tensions in labor markets, income inequality, and political dissatisfaction are intensifying. Historical precedents remind us economic and political crises often cluster in these long downturns before breakthroughs occur. The current state of politics, social unrest, and economic malaise reflect the deep structural challenges that must be addressed to avoid prolonged stagnation or worse outcomes.